Hello and welcome to Buy or Sell. I'm Ali Selby, and today we're very lucky to be joined by the fiercely smart and wonderfully fabulous Vihari Ross from Antipodes. We're going to be discussing whether the market is getting too hot, as well as some of the stocks she believes could give you uncorrelated returns right now. Now, I have to warn you, we will be talking a little bit about whether or not the market may be getting a little bit closer to bubble territory to start off today. So just be patient with us. We will get into some of the stocks Vihari is liking today and some of the stocks she's shorting as well. Okay, Vihari, let's get straight into it. Thank you so much for joining us today. I'm really excited to speak with you.
Thank you for having me today. It's great to be here.
There's a lot of market commentators who are drawing parallels between now and the dot-com bubble. If we are kind of approaching dot-com bubble territory, do you think we're in 1999 or 2000?
That is such a tricky question. I think what you're alluding to is so right, which is that there's a lot of risks building, under the surface. On the surface, everything is sunshine and rainbows, but under the surface, there's these building risks. Markets getting more and more concentrated. Valuations are going higher and higher in the US, though we had the wobble earlier this year. But I think it's interesting to look at it from a few different lenses. And one is that, on a multiple basis, multiples at a market level are actually lower than the year 2000. Not necessarily sales multiples, but PE multiples. But then the concentration is higher than it's ever been. So the top 10 companies are in the US anyway, are more than 30% of the market cap, which is the highest it's ever been. Are we in 1999 or 2000, or are we in 2007 or 2006? I think, the concentration isn't the only risk that's building up in markets right now. The other, the thing that caused the GFC obviously was a bit of a credit crisis around subprime. This time there's also building credit risks and there's tech exuberance. So you've actually got a few things bubbling. What triggers it? We don't know yet, but we can see, risk around the private credit cycle, risks around exuberance on a wonderful new technology, being AI versus the internet this time around. It just means that navigating that is, you have to be laser focused on valuation, because the expensive stocks will fall. They'll draw down no matter how wonderful they are and how important they are to the building of AI. But then the flip side of there being such a concentrated rally is there was a whole bunch of stocks left behind that didn't participate, which means for us as value investors, there's a lot to actually lean into right now as well.
I guess the hard thing on what the bulls are saying is there has been like this earnings support behind some of these AI-led companies. Do you feel like, that makes it different to the dot-com boom and bust?
Certainly we don't have as much of the pets.com of the year 2000.
Cisco's.
But there was exactly Cisco. There was 3 really, really big companies in the year 2000, Intel, Cisco, and Microsoft. And it's not that they weren't important. you needed Intel chips to build the internet. You needed Microsoft. You needed Cisco. They built what I like to call it the foundation stone of the internet. You couldn't build the house without the foundation stone. And it wasn't that they didn't matter. They really mattered. The internet wouldn't exist without them. And they were really high quality. And Cisco earned like $1 billion at that time. It wasn't that it wasn't successful. It was just really expensive. It was trading at like 500 times that. So the reason they all fell like 80% thereafter wasn't because they weren't good. It was because they were too expensive for what they were. So similarly here now, I think it's about, let's look at the future versus the past, in terms of where this is going. Market multiples for a lot of these companies are, NVIDIA is cheaper than Cisco was back then, for example. But it looks better on a PE basis than it does on a sales multiple basis. And on a forward-looking basis, that matters because they're not likely to keep earning, 70% gross margins forever. And if that margin comes down, then suddenly the PE multiple looks a lot higher than what it looks like right now. So it's a little bit about stock picking in those big tech stocks rather than sort of blanketly going, they're all expensive, because actually some of them still look compellingly valued. And there's other parts of the market that are expensive instead. So I think it really is about navigating what's expensive, what's cheap, and positioning accordingly.
I feel like we haven't really seen like a GFC type or like dot-com boom bust type crash for a long time. I know we had obviously the COVID crash, but the recovery was so quick for that. It wasn't like this drawn out, terrible period of time. Do you think we could be in for like a bigger, badder, longer, more painful crash?
Yeah, like I think it's definitely, the risks are definitely building. The year 2000 and the GFC, markets fell 50% in both of those. And then the subsequent four that we've had, including COVID and then including the one we had earlier this year, they were sort of almost baby drawdowns in comparison. They were sort of that 10 to 20% range drawdown. And we did bounce back really fast from that. When you get points of extreme market concentration, the way that concentration dissipates, because it always dissipates, is it's always the same. It's expensive stocks fall and cheap stocks catch up. And I think that's the sort of juncture we're at now, which is that you've got a lot of expensive stocks, but what could trigger it could be something more substantial. And this is why everyone's paying so much attention to the US economy. If you've got an economic downturn in conjunction with, increasing corporate loss rates and these high valuations, that's when you can have something worse go down compared to the baby drawdowns we've just had.
Are you seeing any signals of that? I mean, I am addicted to reels, and I've definitely seen a shit ton of reels about like recession indicators in the US and a lot of skits about that. So I feel like the US is definitely feeling some pain. I've seen a lot of like reels about people making their own butter and like, I don't know, going back kind of like COVID crisis times where it's like, oh, look, I can make this really cheap meal. Like, what are you seeing in terms of like economic indicators right now in the US?
I think that's the thing. It is like, how is the US going to play out? And I think it's sort of similar to Australia, right? That you've got a whole bunch of people who are actually doing it kind of tough, like the sort of bottom half or bottom third demographically. They're probably renting the house they live in, which has gone through the roof, the cost of that. The cost of food and services has gone up so much. And it's like people talk about inflation coming down, but that's just the rate of increase coming down, not the actual prices coming down. And then getting a tradie to your house, the cost of that has gone up so much. And so you've got this real pressure. And if you think about the cost of credit cards and the cost of getting an auto loan, that's sort of
Cost
more
of
than
healthcare.
cost of healthcare. Like it's all over 10% for a credit card loan or an auto loan. So you've got that cohort of people actually not necessarily living their best life. And then you've got the people who are the net savers, maybe that top third of people who invested in the stock market, although that's a whole nother topic of more and more people are investing in the stock market than ever before, including sort of instead of housing, for example, in the US. That's been a whole nother phenomenon. But those people are doing great because they're getting high rates of interest on their savings. They've just made all this money out of markets in the last few years. So it actually makes, the central bank's job really hard because you've got people doing it tough, but also people doing well. What you're starting to see is, in terms of I would say the balance sheets of corporates, of listed, most like large cap listed corporates are like the best they've ever been. They're pristine. They look amazing. But as always with, like in the case of subprime, it was only the bottom 20% of borrowers who were trouble. Everyone else was fine. And it's sort of similar here where you've got that bottom end of corporates and what we'd call that sort of junk bond type part of the market where there is actually a lot of risks that have built up. Private credit's grown 20% per annum over the last 5 years. It's actually made traditional junk lending like high yield and leverage loans like the highest quality they've been in ages because it all went to this other part of the market, which was private credit. These are real businesses. They're not like in Australia, it tends to be more, real estate lending in private credit. Over there, it's SMEs, it's everyday companies, it's healthcare companies, it's tech companies, it's retail companies. And they are geared up. They are so geared up. They've got, the average is, 6 to 7 times debt versus their earnings. And then, as always, how fat is the tail? So the tail is really, really fat. You've got like a third. They've done an analysis. The IMF did all this analysis. The bottom third of those corporates that have really high gearing have an interest coverage ratio of less than 1. which is they don't actually make enough money to even pay their interest right now. So that is there. It's just, and they're just hoping to, they're trying to get to the other side of the swimming pool, and hopefully rate cuts come along to like save their skin. So there's definitely risk like that building. They are big employers as a group across the US economy as well. So, and that's really driven a lot of that US exceptionalism. And the reason I kind of point to these things as risks is because the US is priced for sunshine and rainbows. It's not priced for anything to go wrong. So that's where the risk lies, because if things do go wrong, it's priced for perfection. Whilst in other parts of the world, it's already priced to go wrong. So if it ends up being better, there's actually a lot of opportunity.
Okay, let's say something does go wrong. We do have like a market crash. I feel like often at the end of a bull market, there's like this period where markets just go crazy, really hot, incredible returns in that very, very final part. Are you holding any spicy stocks in the portfolio with that in mind to like take advantage of that, I guess, final push?
Yeah, so I would say, again, it's all about what's cheap and what's expensive. And what I would say in general in this very exuberant market we've seen is that there is more than one way to make money. And the interesting thing that happens in that final push actually is, yes, returns get more concentrated, but then they start broadening out. And normally the market actually pushes higher from a broader base first before any crash happens. So there is a lot of opportunity, I would say. Where does the valuation opportunity lie? I would say it's in general outside of the US. It's in value stocks rather than quality and growth stocks. And it's also in smaller to mid-sized companies than in larger caps. That's speaking in general.
So you're not holding NVIDIA, for example?
No, I mean, we're definitely not owning NVIDIA. That's a really good example of a stock that looks okay on a PE basis, but on a sales multiple basis is very high. Enterprise value is sort of over 30 times. Its profitability is really high. And if you look forward, their customers want them to have competition because they don't want to be held by the proverbials by NVIDIA and their monopoly level pricing. So you've already got competitors coming into the space. You've got the hyperscalers themselves looking for their own alternatives. And to give you an analogy, actually, Amazon Web Services, their cloud business is all built on custom chips, custom silicon. They don't use Intel chips for data centers. So I think the hardware layer ultimately got commoditized back in the internet era, and the hardware sort of element of this AI trade may also, face commoditization risk. So NVIDIA's out.
Are you shorting NVIDIA then or selling?
We're just not. It's such a big stock in the market. Not owning it is enough. And honestly, if we think of that whole value chain, NVIDIA designs chips, but there's another company that makes the chip, the silicon chip that goes into it. There's another company that sells the lithography equipment to TSMC that makes the chips. There's another 2 companies in the world who make design software that the designers of chips use. There's other companies that make memory that slots into the motherboard. So there's actually a lot of players here. There's other companies that do, systems testing and measurement, because of course you can't build these chips without a whole amount of simulation and testing. So there's more than one way to play an AI thematic. It's not going away. We're really at the very beginning of this huge investment cycle, but you don't have to buy the meme stock to buy the idea. And we don't want to overpay. That's the discipline we always have. And when it comes to, if you sort of analyze the way our portfolio has delivered returns, we haven't owned NVIDIA, we haven't owned Broadcom or Tesla, but our portfolio has still outperformed, and that's through owning other idiosyncratic ideas. In the year to date, NVIDIA's up 30%. The market's up 10%. Our portfolio is up 20%, but we've delivered returns through things like Siemens Energy, that's up over 100%. Barrick Gold, that's up over 100%. Societe Generale, a French bank, that's up over 100% as well. So it's about finding those ideas, that stock picking, that can help you deliver that above market return, again, without buying those meme stocks.
I know that you do like one AI name. Can you tell us a little bit why you're buying AMD?
Yes. So AMD is a great example of not having to own the NVIDIAs of the world. So AMD, they've actually got, back 2018, pre-2018, they only had 1% share of CPUs. Now they have 24% share
Wow.
of CPUs. They came out of nowhere, but it wasn't entirely nowhere because they knew Intel had it all sort of sewn up. The way they looked to get into that market was by thinking about where is the growth coming from, and it came from the cloud. It came from data centers. So they ended up entering the market, through a side door, which was through the demand in chips that was going to come from, the hyperscalers and that data center build out. In a similar way, if we look at AI, a lot of the workloads up until now have been training AI models as opposed to inference, the interrogation and the asking questions of the AI models. And a lot of that's shifting towards inference. In a similar way, AMD's, getting into this market through that inference side, where that shift is taking place. And they've got an opportunity. We've only really got a model that for them to take sort of 8 to 10% market share here in order to justify, this investment case. And of course, we know that the customers want variety. And you've seen a whole bunch of news just this week of OpenAI and others looking for alternative sources from NVIDIA. So you've got this business that has a substantial market share opportunity, but with a market cap of $250 billion versus NVIDIA at $4 trillion. So that's...
It has run, though, this year. It's up like nearly 80%. And there's been all this worry about like AI-related companies investing in each other and that cross-investment and what that means. Like, do you think that could be a risk?
Yeah, look, I think the big swing factor for these stocks is how big is data center CapEx going to be from the hyperscalers. So much of the CapEx has been, just making buildings and stuff, and as opposed to just buying chips. And
so spend a lot on chips as well.
Yes,
though.
also spend a lot on chips.
So much money on chips.
But one of the really interesting elements of this is, yes, you've got OpenAI almost, backstopping a lot of this potential spend. But I think the thing that creates this swing factor here is not whether that investment cycle is going to happen because, foundation level, the forefront type models are still being developed here. But the CapEx, the definition of CapEx normally is that it's investment related. You make an investment and then hopefully you get a return on that investment. So the hyperscalers, Google and Meta and Microsoft's CapEx is NVIDIA's revenue. And I think that's a really interesting thing to think about in the sense that normally CapEx is not something that just stays there forever. It's being extrapolated into sort of permanent revenues for the likes of NVIDIA, when in fact there could be like a CapEx cycle where, you spend a bit and then you don't spend a bit for 5 years and then you spend a bit more. And I think that is actually probably more the swing factor for those types of companies than, historically speaking, companies like TSMC, which we also own, have been really cyclical.
Yeah.
And that's the nature of that sort of hardware build out. So I think that's actually a bigger risk for those types of companies. But the cycle persists. It's a matter of whether there's a cycle within this longer term trajectory that we're going to see. And that could really shake out the likes of NVIDIA that are priced way more exuberantly than AMD is.
How about companies that are using AI to supercharge their businesses? We're definitely doing that at Minotaur. Are there any companies that are listed that you think are really exciting in terms of their use of AI?
Yeah, look, I think that's actually probably where AI is most mispriced. I would say that, DeepSeek probably got people thinking about the concept of how might people actually use this now that it's getting cheaper. And again, I'll draw the analogy. If you think about who really made money out of the internet, it was the platform companies that built the house on the foundation stone. They came 10 years later, Google and Meta and Facebook and all those early apps.
Although Microsoft
Amazon
has made a lot of money.
Yes, Amazon, yes, but that's thanks to building the cloud. So it's a different business. And in a similar way, companies that can use this wonderful new technology to make their own business better are really well positioned. So thinking about, we've already seen Meta do it. They're monetizing those eyeballs on their platform so much better than they ever did before.
Do you own Meta?
No, we don't own Meta at the moment. We sold it earlier this year though, so we have held it. We actually held it since the Cambridge Analytica scandal.
All
It was
right.
a good opportunity, sort of a good contrarian stock picking opportunity, which is sort of what we're, bread and butter of what we do at Antipodes. Finding mispricing when people are throwing the baby out with the bathwater in otherwise resilient businesses. So I think here, companies with, well-organized information, well-organized data, and then the ability to then use that so financials is a good example, healthcare is a good example, but I'll give you a slightly different example, which is Tencent. It's obviously a Chinese tech company. There's 1.4 billion monthly active users on the Weixin, the WeChat ecosystem. And so what that means that they can do, we've already seen the playbook of what Facebook has just done in terms of monetizing those eyeballs, getting way better advertising bang for buck from being able to harness the data of their users better. So you've got, essentially you've got margin expansion taking place through that business. It's already a high margin business, but as a result of being able to use AI. Another good example, which kind of ties into that cyclical opportunity in the US, is Capital One Financial. It's a US.
You guys have loved that stock for a long time.
Yeah, it's actually been a really great contributor as well for a period of time. They've now had the approval to do the Discover Financial deal, which is so they're going to be an end-to-end credit card provider in the US. They provide the credit as well as the railway tracks for all those payment transactions to take place. It's a business that is trading, on a 10 times multiple compared to the Visas and MasterCards of the world, significantly cheaper, as well as has all its data already digitally native. So the perfect opportunity to, use AI. And their return on capital is as good as JP Morgan's, it's as good as CBA's and Visa and MasterCard. So you've got this, real value opportunity in stocks like that as well. Notwithstanding the fact that obviously in order to use AI, you've got to get your data onto the cloud. And so the cloud providers are still getting a lot of growth as a result of that shift taking place as well.
You are net 77% invested right now. You're putting your money where your mouth is in terms of like what you're feeling about the outlook for markets. Where are you finding uncorrelated value right now?
Where we're seeing the value is outside of the US. We're seeing it in smaller to mid-sized companies, and we're seeing it in value stocks. And really, there's US cyclicals is a good example of where you can find value in the US. There's not a lot of value in quality and growth, but there's value in cyclicals. I gave you Capital One as an example there. Outside of the US, we quite like Latin America. Having said that, there's 15 countries represented in our portfolio, so it's not just picking a region necessarily. But there's some great quality, growth, and value in one stock available. A great example of that's Nubank. It's a fintech, essentially a digital bank in Brazil. They've added 60 million customers in the last 4 years. So they're getting more than 20% growth. They've just launched in Mexico as well. And so you've got that potential explosion of growth to come there. And they're getting really high returns on capital. They don't have a branch network, really low cost base. And again, that's a great example of the type of opportunity, if you're willing to look in the big wide world out there to sort of tap into. And the US is 70% of the world, but definitely not 70% of the opportunity.
How about in China? Are you seeing any opportunities there?
Yeah.
I know you talked about Tencent before.
Yeah.
Is there anything else that you're liking?
Yeah, look, we do like Tencent. We also have an investment in CATL. That's a global leader in battery technology.
I've never heard of it. And it's
it's probably
leader.
It is a global leader. In fact, they've got such a significant technology leadership that they sort of have become essential to that EV supply chain. So that's another good example. We have a number of other investments in China. It's probably just under 10% of our portfolio at the moment. But what we're finding is that there's a lot of compelling value there because the whole market's become cheap as a result of people getting a bit too scared, but actually getting really well compensated for the risk there. And you don't even have to necessarily go down the property developer end of the spectrum to find value. You can actually find structural growers and you can find quality companies in China at the moment.
How about stocks that you're not so hot on? I know that you are shorting quite a bit right now. both individual shorts, basket or group shorts, and then index shorts. What are the things that you're selling or shorting, betting against right now?
Yeah, so we've got in terms of the, like I would say, I talked a little bit about that, that private credit risk, where you've got this sort of fat tail of potentially really risky corporates. It's growing really fast. It's hard to, exactly short those directly, because obviously they're private by nature, but we have had some shorts in that private credit or companies that have built out big private credit style businesses
What would those
in the
be?
US, companies like the Blackstones of the world. They've worked really well. And then we've also got what we call a probability of default basket short as well. And that's it's actually just listed companies that have very similar characteristics to those sort of more dodgy private credit companies, and that's actually just it's sort of been a structural underperformer, and so that's been a good contributor to the short book as well.
So almost just like a basket of zombie companies?
Yeah, companies that are just really highly levered and are having essentially, if you look at the US and you think about which are the really expensive stocks in the US, as I've alluded to, let's identify what they are. And people often jump to the conclusion that she's talking about tech, and I'm not necessarily talking about tech. What I'm talking about more so is quality. People know what a value trap is. People know what a growth trap is. But I'm kind of starting a new phrase, and that's the quality trap. And people right now the market is really paying through the nose for quality. And if you think about where quality is trading at double the multiple of value, so we're talking about values like on a 10 times multiple, qualities on a 20 times multiple, but these companies are growing no faster than value companies. They're still growing at 6%. So I'm talking about companies like Costco and McDonald's and Nike and these companies that everyone knows about and they think, it trades on now. So it's great to buy quality but not overpay for quality.
Yeah, it's so interesting on that, just because I feel like Australian fund managers at least are obsessed with quality stocks in Australia. Like there's just this obsession with high conviction quality portfolios. You've got a lot of people holding Hemnet, all those kind of companies, but then they haven't, done that well.
Yeah, it's interesting to think that if you actually look, so 2025, I think I mentioned, you get, when markets top out, they start to broaden out first. And in 2025, you actually had a broadening out happen. And surprise, surprise, quality, which is expensive for what it is, started to derate. And I just think this is a function of, what Charlie Munger said, which is that in the short term, the market's a voting machine, and in the long term, it's a weighing machine. So the true worth of those businesses, if something's overvalued, it's just not going to keep that valuation forever. And I think that's what you've started to see. And honestly, there's cheaper ways of sometimes playing those thematics. I gave you the example of the payments, in Capital One. You don't have to pay up for the large cap version of it or the meme stock version of it to get access.
Okay, last question for today. I always like to end with like a really sexy stock or a spicy stock that you think could go really well going into the end of the year, or maybe even the years ahead. What are you buying? What would you recommend to us?
So when it comes to a sexy stock, I'm going to give you an aging demographic hospital provider.
Okay, a very sexy, unsexy stock.
Yes, that's right. So just as important. So I'm going to give you HCA, which is the largest private hospital provider in the US. And if you look at these demographics, this is where you can get a bit excited. The number of over 65-year-olds in Florida is going to grow at more than 30% per annum in the next 5 years. That's a nice growth rate, right? So you've got this company that, what gives it its competitive advantage, it's got really high market share in its key regions, places like Florida. So they've got sort of more than, about the 80% market share in those relevant, biggest regions, which means they've got really good negotiating power with insurers. They've got good negotiating power with, surgeons. The insurance providers have to give the end user access to those hospitals. They're the main hospitals in those states. And in addition, they generate a ton of cash, got high returns. All of the success of that company over the years has actually come from the earnings growth of that company. It hasn't re-rated. It still trades on like 14 times. And they're using that cash flow to buy back stock as well. So they're actually in the next few years buying essentially between 5 to 10% of their shares back per annum. So you've actually got some nice sort of structural tailwinds there, as well as a valuation opportunity and a capital return opportunity to boot.
Okay, well, thank you so much for your time today, Vihari. I really enjoyed this conversation. I'm really grateful for you sharing all your ideas today.
No worries. Thank you, Ali.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.